Most traders believe the distance from 2,000 to 200 is a matter of money. It is not. It is a matter of behavior. That sounds strange, doesn't it? How could the same person who turns $2 into the 20 struggle to turn 20 into 200? How could someone make a brilliant trade one day, then lose everything the next week? The market did not suddenly change its nature. Price still moves. Opportunity still appears. Risk still waits in silence. What changed was the trader. That is where the real conversation begins. You look at a small account and think small money creates small problems. But small money often reveals large weaknesses. When the account is tiny, discipline feels optional. A bad entry seems harmless. A reckless trade seems forgivable. A revenge trade feels easy to justify because, after all, it's only $2. But tell me, if you cannot respect $2, why would you respect 200? Money does not become sacred when there is more of it. Habits simply become larger. That is the quiet truth most traders avoid. A careless mind with a small account becomes a dangerous mind with a bigger one. A patient mind with a small account becomes powerful when capital grows. The amount changes. The character expands. Watch traders closely and you'll see it. One trader enters because price confirms his idea. Another enters because he is tired of waiting. One trader exits because the setup failed. Another exits because fear whispered in his ear. One trader sits on his hands for hours, maybe days, waiting for clean opportunity. Another must always be in motion, must always feel involved, must always press buttons. Which one do you think survives? The market pays patience more consistently than intelligence. That surprises people. They think trading is prediction. It is not. Trading is positioning. It is waiting until odds lean in your favor, then acting with clarity. Then, just as importantly, it is doing nothing while uncertainty reigns. Can you do nothing? That question sounds simple, but it cuts deep. Because most losses are not born from bad analysis. They are born from emotional hunger. Hunger to act. Hunger to recover. Hunger to prove something. Hunger is expensive in markets. The disciplined trader understands cause and effect. He knows that chasing momentum late creates weak entries. Weak entries create stress. Stress creates emotional decisions. Emotional decisions create larger mistakes. Larger mistakes destroy confidence. Destroyed confidence creates hesitation at the very moment opportunity returns. One bad habit becomes 5 consequences. Do you see how quickly a small crack becomes collapse? But the reverse is also true. One strong habit creates another. Clear rules reduce confusion. Reduced confusion strengthens patience. Patience improves entries. Better entries improve confidence. Confidence allows proper execution. Proper execution creates consistency. Consistency compounds. A small strength becomes structure. That is how 2 dulls begins moving toward 200, not through one giant victory but through repeated sound behavior. Now here is where many misunderstand growth. They think scaling is about increasing size. Scaling is really about increasing control. If you double size while keeping the same emotional weakness, you double damage. If you increase exposure without increasing discipline, you magnify chaos. Bigger positions do not create bigger traders. Bigger positions expose smaller minds. So what should you look for? Look at how price behaves near obvious levels. Does it approach with strength or hesitation? Does volume expand or shrink? Does breakout momentum continue or immediately stall? Is rejection sharp or weak and drifting? These details matter because behavior leaves footprints. Markets reveal intention before movement becomes obvious. But here is the trap. Seeing is not enough. Interpretation matters. A sharp rally into resistance may look strong, but ask yourself who is trapped here. Late buyers, early shorts. Are professionals distributing into excitement? Is price being marked higher only to attract liquidity? What is price trying to do? That question changes everything. Most traders ask, where will price go? Better traders ask, what is price doing now? That keeps you grounded in reality rather than fantasy. Reality is tradable. Prediction is seductive, but expensive. And what should you avoid? Avoid forcing trades from boredom. Avoid adding size after random wins. Avoid moving stops because you feel price will come back. Avoid turning analysis into attachment. The market owes nothing to your opinion. Read that again in your mind, nothing. A trader who marries a bias stops seeing clearly. He begins defending rather than observing. Once that happens, losses become personal. Personal losses create stubbornness. Stubbornness creates destruction. Have you ever held a losing trade too long, not because logic supported it, but because pride did? That is not trading. That is ego negotiating with reality. Reality always wins. Now let's make this practical. Start small, but trade seriously. Record every entry. Not just where you entered, but why. What did you see? What confirmed the setup? What invalidated it? How did you feel before entry? Calm, excited, fearful, impatient. Patterns emerge quickly when honesty enters the room. You may discover your best trades happen when you wait for confirmation. You may notice your worst losses come after consecutive wins because confidence quietly becomes arrogance. You may find your emotional trades happen late in the day when mental energy fades. These are edges too, psychological edges, and often they matter more than technical ones, because strategy without self-control is like placing fine machinery in careless hands. The machine is not the problem. The operator is. This is why the journey from 2000 to 200 is not about finding magical setups. It is about becoming the kind of trader who can repeatedly recognize opportunity, act decisively, manage risk calmly, and remain emotionally balanced whether the last trade won or lost. Can you remain steady after victory? Can you remain clear after defeat? Can you stay humble when right and objective when wrong? That is the real test. The market rewards inner steadiness because price itself is unstable. If both you and price are unstable, chaos meets chaos. But if price is wild and you remain composed, now there is contrast. Now there is advantage. Then your decisions sharpen. Then patience becomes natural. Then risk becomes measured. Then growth begins. Not suddenly, not dramatically, but quietly, steadily, almost invisibly at first. And one day you realize the account changed because the mind changed. The numbers followed behavior, not the other way around. Most people think small capital gives them permission to trade carelessly. That is the first mistake. A small account is not a toy account. It is not practice money. It is not money meant for emotional experiments, reckless entries, or random bets disguised as conviction. Small capital is where your trading character is exposed with complete honesty. It shows whether you can follow rules when there is little reward, whether you can stay patient when progress feels slow, and whether you can respect risk before larger money ever touches your hands. Ask yourself, how do you behave when the stakes feel small? Do you chase price because losing a little seems harmless? Do you overtrade because a few dollars feels insignificant? Do you break your plan because discipline suddenly feels unnecessary? That behavior matters more than the amount in your account. Because habits do not stay small. A trader who risks too much with little money will risk too much with larger money. A trader who trades emotionally with 10 will trade emotionally with 1,000. A trader who ignores discipline early is building a dangerous foundation, and foundations decide what can stand when pressure comes. This is why serious traders treat small capital with unusual respect, not because the amount is large, but because the habit being built is valuable. Every careful entry strengthens judgment. Every disciplined stop-loss strengthens emotional control. Every trade avoided for the right reasons strengthens patience. These actions may look small from the outside, but inside the trader, something important is being formed. Professional mindset. That mindset is worth more than fast profits. Many traders want growth before structure. They want bigger wins before better habits. They focus on multiplying money while ignoring the skill required to keep it. But the market has a way of exposing weakness. It gives just enough success to build confidence, then tests whether that confidence is built on discipline or excitement. Most fail that test. Why? Because they treated early trading like entertainment instead of training. They learned speed instead of patience. They learned impulse instead of control. They learned to react instead of observe. And when bigger money arrived, those same weaknesses grew sharper, faster, and more expensive. Small capital should teach precision. Watch price carefully. Wait for clean setups. Enter with reason, not emotion. Risk little enough that one mistake does not control your next decision. Study what happened after each trade, not just profit or loss, but behavior. Were you patient? Were you clear? Did you follow your plan, or follow your feelings? These questions shape traders. The amount in your account does not decide your seriousness. Your behavior does. A disciplined trader with little capital is building something real. A careless trader with large capital is often building collapse. Money only magnifies what already exists. If discipline exists, money expands discipline. If chaos exists, money expands chaos. That is why small capital must be treated seriously from the beginning. Because when discipline becomes normal at a small level, strength quietly forms where most traders remain weak. Most traders only begin respecting money after they lose enough of it. By then, the lesson is expensive. The first dollar in your trading account carries more weight than most understand. Not because of its size, but because of what it represents. It is your first test of judgment, your first measure of discipline, and your first chance to build a relationship with capital based on respect rather than impulse. How you treat that first dollar often reveals how you will treat every dollar that follows. Think carefully. When you place a trade, do you see money or do you see risk? There is a difference. When traders see only money, they become excited by what they might gain. Their attention moves toward reward, and reward creates emotional blindness. They enter too early because they fear missing out. They hold too long because greed begins whispering promises. They increase size without reason because confidence becomes intoxication. Their decisions stop being sharp and start becoming emotional. That is where respect disappears. But when traders see risk first, something changes. Their thinking becomes calmer. They begin asking better questions. Is this setup clear, or am I forcing meaning onto noise? Is the reward truly worth the risk, or am I chasing movement because I feel restless? Is this position size logical, or is emotion quietly making decisions behind the curtain? Respect creates awareness, and awareness protects capital. Many people lose their first money in markets because they treat it lightly. Small losses seem harmless. A reckless trade feels easy to dismiss. Breaking rules feels insignificant because the amount is small. But the market is not measuring the dollar amount. It is reinforcing behavior. Every careless action strengthens carelessness. Every emotional decision teaches the mind to repeat emotional decisions. Habits are forming long before wealth arrives. That is what makes the first dollar important. It teaches you whether you are building control or feeding impulse. A trader who respects the first dollar thinks differently. He does not rush to trade simply because the market is open. He understands that capital is inventory, and inventory must be protected. Every dollar lost unnecessarily is not just money gone. It is opportunity removed. It is fewer chances, less flexibility, and greater pressure on future decisions. Pressure changes behavior. A trader under pressure forces setups. He becomes impatient. He starts chasing losses. He begins trading from need instead of logic. Need is dangerous in markets because desperate minds cannot see clearly. Respecting money keeps desperation away, and respect is shown in simple actions, using proper position sizing, accepting small losses quickly, refusing low-quality setups, and knowing that preserving capital is progress, even when no trade is placed. Ask yourself, do you protect money like a professional or spend risk like an amateur? That answer explains more than strategy ever will. The trader who respects $1 learns to respect 10. The trader who respects 10 learns to respect 100. Over time, respect becomes instinct, and instinct shapes every decision made under pressure. That is where discipline begins. Most traders believe a bigger account will solve their problems. It usually makes them worse. They think more capital means more opportunity, more freedom, more room to recover mistakes. But capital does not correct weakness. It exposes it. It amplifies it. Whatever habits exist in a trader when the account is small will grow louder when the account becomes larger. Money is not a reset button. It is a magnifier. Ask yourself, what would happen if your position size doubled tomorrow? Would your discipline remain steady? Would your rules still matter? Would your emotions stay quiet when price moved against you? Or would fear become sharper, greed become stronger, and decision-making become clouded by the weight of larger numbers? This is where habits reveal their true power. A trader who exits early from fear with small money will likely exit even faster with larger money. A trader who moves stop losses out of hope when risk is small will move them farther when risk becomes uncomfortable. A trader who chases momentum without patience on a tiny account will chase it harder when bigger gains appear possible. The account grows. The behavior grows with it. That is why habits scale faster than accounts. Long before money multiplies, patterns of thinking are already being built. How you respond to losses becomes a habit. How you handle waiting becomes a habit. How you behave after a winning streak becomes a habit. Even how you think during quiet market conditions becomes part of your trading identity. An identity is difficult to change under pressure. Pressure does not create character. It reveals what has been practiced repeatedly. A disciplined trader under pressure becomes more disciplined because structure is already built into his actions. A reckless trader under pressure becomes more reckless because chaos is familiar territory. When emotion rises, people fall back on habit, not intention. That is why building the right habits early matters so much. Patience must become normal before size increases. Risk management must become automatic before profits expand. Emotional control must become stronger than impulse before larger money enters the picture. Without that foundation, growth becomes dangerous because bigger capital gives weakness more room to damage. Many traders mistake temporary wins for progress. But winning carelessly is often more dangerous than losing wisely. A lucky trade can reward bad behavior, and rewarded behavior becomes repeated behavior. A reckless, oversized position might create a quick gain, and suddenly the trader begins believing risk is skill. That illusion can survive for weeks, sometimes months, until one undisciplined decision erases everything built on false confidence. Because always catches effect in the market. Sooner or later, behavior gets audited. So watch your habits closely. Notice what you repeat. Notice what triggers impatience. Notice how you behave after success, after loss, after boredom, after frustration. The repeated action becomes the permanent pattern, and permanent patterns shape long-term results more than any single strategy ever will. Because when discipline repeats, discipline compounds. Most traders believe action creates profit. In truth, unnecessary action destroys it. The market has a way of convincing people that movement must be matched with movement. Price rises, and traders feel they must chase it. Price falls, and they feel they must react. Charts move, headlines change, candles form, and suddenly stillness feels uncomfortable. Waiting begins to feel like missing out, and impatience quietly takes control. But ask yourself, how many of your bad trades came from clear opportunity, and how many came simply because you were tired of waiting? That question exposes more than strategy ever will. Patience is not passive in trading. It is active discipline. It is the ability to watch without reacting, to observe without forcing meaning into random movement, and to remain mentally sharp while doing nothing at all. That takes more strength than most understand. Anyone can click buy or sell. Few can sit still while opportunity slowly forms. And opportunity does form slowly. Strong setups rarely arrive in emotional noise. They appear when price reaches meaningful areas, when volume confirms intention, when structure becomes clear, and when risk can be measured with reason rather than hope. Clean trades often look obvious in hindsight because patient traders were waiting for clarity while impatient traders were busy gambling in confusion. This is why patience becomes leverage. A patient trader avoids weak setups. Avoiding weak setups preserves capital. Preserved capital keeps emotion stable. Stable emotion improves judgment. Better judgment leads to cleaner execution. Cleaner execution creates consistency. Consistency compounds over time. One disciplined decision creates another. That is leverage. Impatience creates the opposite effect. A rushed trade leads to a weak entry. Weak entries create stress. Stress creates emotional exits or reckless averaging down. Losses build frustration. Frustration creates revenge trading. Revenge trading destroys discipline completely. One moment of impatience becomes a chain of expensive mistakes. Cause always follows cause in markets. Nothing happens alone. Many traders think leverage is borrowed money or larger position size. But real leverage is patience because patience increases quality. When quality increases, mistakes decrease. When mistakes decrease, capital lasts longer. When capital lasts longer, opportunity remains available. And when opportunity remains available, the trader can wait for moments where odds truly lean in his favor. That is quiet power. Look at skilled traders and you'll notice something unusual. They often seem inactive. They spend more time watching than trading, more time planning than executing, more time rejecting trades than entering them. From the outside, it appears slow. From the inside, it is precision. They understand that not every market movement deserves participation. Sometimes the best trade is the one ignored. Can you watch price move without chasing it? Can you see opportunity in waiting rather than constant action? Can you trust discipline enough to let weak setups pass, even when your mind wants excitement? That is where patience becomes strength. Most traders do not lose because they cannot read charts. They lose because they read hope into charts. That is a costly difference. The market is always speaking through behavior, through price movement, through volume, through hesitation, through aggression, through rejection, through acceptance. It leaves clues constantly. But many traders do not study what is happening. They study what they want to happen. Their eyes are open, but their judgment is clouded by expectation. Ask yourself, when you look at a chart, are you observing or are you wishing? That question separates clear thinking from emotional thinking. Hope is dangerous because it changes interpretation. A weak rally suddenly looks strong because you want confirmation. A failed breakout appears temporary because you want price to continue. Heavy selling gets dismissed because accepting reality would mean accepting you were wrong. Hope bends facts until facts no longer look like facts, and the market punishes distorted vision. Behavior tells the truth more honestly than opinion ever will. Watch how price reacts at important levels. Does it break through resistance with force, or does it hesitate and pull back? Does selling pressure create sharp rejection, or does price drift lower without conviction? Does volume expand when price moves, showing real participation, or is movement thin and fragile? These details reveal strength, weakness, confidence, or uncertainty. The clues are there. But you must look without attachment. That is where most fail. They become married to an idea. Once that happens, they stop reading behavior and start defending belief. Every candle becomes personal. Every pullback becomes temporary. Every warning sign gets ignored because ego quietly takes control. Now they are no longer traders. They are advocates for a position. The market does not reward attachment. It rewards objectivity. Objectivity means accepting what price is showing now, not what it showed yesterday, and not what you imagined it would show tomorrow. If momentum weakens, you acknowledge weakness. If buyers fail to follow through, you recognize hesitation. If structure breaks, you accept that the setup changed. No argument, no negotiation, no emotional debate, just observation followed by disciplined action. This creates a powerful advantage. When you read behavior instead of hope, decisions become simpler. Entries become cleaner because confirmation matters more than excitement. Exits become easier because warning signs are respected early. Risk becomes manageable because reality guides action instead of emotion. Cause becomes visible. And once cause is visible, effect becomes easier to understand. A sudden move higher after long, quiet accumulation tells a story. A breakout that instantly collapses tells another. Price rejection at highs with increasing volume tells another. Each movement carries intention, but only for those willing to watch honestly. Can you see what is there without adding what you want to see? Can you remain neutral when emotion wants certainty? That is real market reading. Most trading mistakes are not born from bad analysis. They are born from emotional hunger. That hunger is quiet at first. It doesn't announce itself clearly. It disguises itself as confidence, urgency, ambition, or instinct. You feel a pull to enter a trade quickly. You feel restless when the market moves without you. You feel the need to recover losses fast, or the urge to press harder after a winning streak. It feels like opportunity. But look closer. It is appetite without discipline. Ask yourself, how often do you trade because the setup is clear, and how often do you trade because something inside you wants action? That answer explains many losses. Emotional hunger makes traders impatient. It creates the need to always be involved, always searching, always pressing buttons. Silence becomes uncomfortable. Waiting feels like weakness. Watching price without participating starts to feel like wasted time. So they force entries where there is no edge, invent conviction where there is only uncertainty, and risk money simply to satisfy an inner craving for movement. That craving is expensive, because hunger distorts judgment. A hungry trader sees setups that are not truly there. A hungry trader increases size because small gains feel too slow. A hungry trader holds losers too long because admitting defeat feels unbearable. A hungry trader jumps from strategy to strategy, believing the problem is the method, when the real problem is the inability to stay still. And stillness is where discipline is built. Markets do not reward emotional appetite. They reward emotional restraint. Restraint keeps thinking clear. Clear thinking improves timing. Better timing reduces unnecessary risk. Reduced risk protects capital. Protected capital removes pressure. Less pressure keeps emotion steady. Steady emotion allows patience. Patience reveals real opportunity. One controlled impulse strengthens another. That is how strong traders are formed. Emotional hunger creates the opposite chain. One impulsive trade creates stress. Stress creates poor decisions. Poor decisions create losses. Losses create urgency. Urgency creates reckless behavior. Reckless behavior deepens damage. Soon the trader is no longer following a plan. He is feeding emotion, one decision at a time. This is how accounts bleed slowly, then suddenly. The market becomes dangerous when your inner state becomes unstable. Look carefully at your triggers. Do losses make you desperate? Do wins make you greedy? Does boredom make you reckless? Does fear of missing out pull you into weak trades? Emotional hunger always has a doorway, and if you do not know where yours is, it will keep entering quietly. Awareness closes that door. A disciplined trader does not remove emotion completely. He learns to recognize it before acting on it. He notices urgency and waits. He notices greed and reduces size. He notices frustration and steps away. He understands that emotion is information, not instruction. That understanding changes everything. Excitement is one of the most expensive feelings a trader can follow. It feels powerful in the moment. Fast, moving price, sudden volume, sharp candles, quick momentum. The screen comes alive, and so does emotion. Your mind begins racing. Opportunity feels urgent. You start believing speed means certainty, movement means strength, and action means profit. That is where mistakes begin. Ask yourself, how many times have you entered a trade because it looked exciting, only to watch excitement disappear the moment you were in? That pattern is common for a reason. Excitement creates impulsive thinking. When emotion rises, observation falls. Traders stop asking important questions. Where is price coming from? What level is it approaching? Is momentum real, or is this simply a short burst before reversal? Is volume confirming strength, or is price moving on thin participation? What is the broader structure showing? These questions require calm thinking, but excitement rarely allows calm thinking. It pushes action before clarity, and action without clarity becomes gambling dressed as confidence. The market often uses excitement as bait. Sudden breakouts attract late buyers. Sharp drops pull in emotional sellers. Violent candles create urgency because traders fear missing the move. But by the time excitement reaches most people, smart money is often already positioned, already managing risk, and sometimes already preparing to exit into that emotional wave. This is why chasing excitement usually means entering late. Late entries create poor prices. Poor prices create stress. Stress creates emotional exits or stubborn holding. Emotional exits lock in losses. Stubborn holding deepens them. One exciting moment becomes a painful lesson. Cause and effect move quickly in markets. Clarity moves differently. Clarity is quieter. It appears when price confirms direction near meaningful areas. It appears when movement is supported by structure, volume, and behavior that makes logical sense. It appears when risk can be defined clearly before entry. It appears when the setup does not need emotional justification because the evidence is already there. Clear setups do not beg for attention. They invite calm decision-making. This is what disciplined traders wait for, not adrenaline, not noise, not random movement that feels powerful for a few minutes. They wait for conditions that make sense, where reward is measured, risk is controlled, and behavior aligns with probability rather than emotion. That kind of waiting feels boring to impatient traders, but boredom is often where discipline lives. Can you sit through exciting moves that do not fit your plan? Can you watch others chase momentum while you remain still? Can you trust that missing a bad trade is not missing opportunity? That requires strength. Because trading is not about following what feels intense. It is about following what is clear. Excitement clouds judgment, but clarity sharpens it. Excitement pulls you toward action, while clarity allows you to act with purpose. One is emotional energy, the other is disciplined vision.